What happens when a once thriving retail landmark gets a new lease on life? Welcome to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. Let's get right to it. Fort Lauderdale's Galleria Mall, a beacon of retail activity since the 1980s, has changed hands. This iconic mall was sold to a consortium of investment and real estate firms, including GFO Investments, Insight Group, Prime Finance, and Atlas Hill Real Estate. The new owners have ambitious plans to transform this pedestrian property into a community-focused retail and lifestyle destination. According to a news release, these firms are dedicated to reimagining the Galleria Mall as a vibrant hub that combines retail, culture, and community engagement. The national real estate firm CBRE initiated the sale process back in late 2023, and it appears that the mall's future is set to be both innovative and community-centric. The location, situated on East Sunrise Boulevard, boasts a rich history and a prime position just west of the Intracoastal Waterway. Despite past attempts at rejuvenation being thwarted by neighborhood objections, the new owners are optimistic about their vision. They aim to restore the Galleria as Broward County's premier shopping and lifestyle destination. The current retail offerings include major brands like Apple, Macy's, and Dillard's, along with popular dining options such as Blue Martini and the Capitol Grill. The acquisition group has promised to reveal detailed plans in the coming months, though the sales price remains undisclosed and representatives were unavailable for interviews. Sandeep Mathrani, founder and managing partner of Atlas Hill Real Estate, highlighted the mall's integral role in Fort Lauderdale's retail scene. With its distinguished location and legacy, the group sees an opportunity to create a modern destination that both honors its history and introduces new experiences for residents and visitors alike. In Dublin, California, the city is gearing up for community discussions about an exciting new development proposal. 2 four-story hotels, along with a restaurant and retail building, are on the table for a 5.75-acre property located at 3800 Kaiser Road. The owner, Venkata Manava, envisions 2 hotels offering 114 and 124 rooms respectively, complemented by a 10,178 square foot restaurant and retail space. This proposal also includes 310 parking stalls and various site improvements. The City of Dublin plans to host 2 community meetings to present the details of this project. These meetings are scheduled for Wednesday, September 24th at 6 o'clock p.m. and Thursday, September 25th at 7 o'clock p.m. Both meetings will be held via Zoom, ensuring accessibility for those interested in learning more about the development. The proposed hotels and accompanying retail spaces promise to enhance the local economy and provide new amenities for residents and visitors alike. The community meetings will offer a platform for residents to voice their opinions and engage with the city's planning process. This development in Dublin is a reflection of the broader trends we're seeing across North America, where mixed-use spaces are becoming increasingly popular. As cities evolve to meet the demands of modern living, developments like this one in Dublin serve as a testament to the dynamic nature of urban planning. The United States commercial real estate market is undergoing a seismic transformation. According to a Yahoo Finance analysis, the sector is grappling with a fundamental and lasting shift. This shift is driven by a wall of maturing debt, tightened lending criteria, and plummeting property values. The office sector, in particular, is at a critical inflection point. Data from the Indexbox platform reveals that approximately 30% of office buildings now account for 90% of the vacancies. A significant portion of these vacancies may never recover, while the remaining 70% face a long road to stabilization. Elevated capital costs are expected to persist, with the United States 10-year Treasury yield forecast to rise from 4.46% in July 2025 to 5.78% by July 2035. This is causing banks to grow increasingly skittish. The Federal Reserve Bank of St. Louis reported that commercial real estate loan growth had plummeted to an 11-year low in May. Additionally, the New York Federal Reserve has warned that these risks will continue to pressure bank balance sheets for years to come. This dislocation in the market is creating a primary role for special situation investing and private credit. This sector has grown by 50% in the past 4 years, reaching a market value of $1.7 trillion. As traditional lenders pull back, this flexible capital is stepping in to fill the void with solutions such as preferred equity, mezzanine debt, and bridge loans. The winners in this environment will be strategic operators with the operational expertise to manage properties directly and navigate complex capital markets, rather than passive buyers. The Irwindale Business Park in California is set to undergo a significant transformation. Voigt Real Estate Services recently completed the sale of the property, located at 1400 to 1430 Arrow Highway in Irwindale, for $10,053,160. The buyer, Dunbar Real Estate Investment Management, plans to divide the 51,487 square foot multi-tenant industrial and distribution park into industrial condominiums. This business park, which consists of 3 grade-level freestanding buildings with a total of 16 units, was only 56% occupied at the close of escrow due to recent fire damage. Dunbar intends to extensively renovate the property and process a new parcel map to create these individual industrial condos, which will be available for sale to owner users and investors. This development is part of a broader trend in the industrial real estate sector, where properties are being reimagined to better serve the needs of modern businesses. It reflects a growing demand for flexible industrial spaces that can accommodate a variety of uses, from warehousing to small-scale manufacturing. The move to convert existing industrial properties into condos is gaining traction, particularly in regions with limited land availability for new developments. This approach allows businesses to own their space, providing stability and potential for capital appreciation. In Ontario, Canada, particularly in regions like Kitchener, Waterloo, and Cambridge, we're seeing similar trends. The demand for industrial space remains robust, driven by the growth of e-commerce and logistics. As more businesses look for ownership opportunities, the concept of industrial condos is gaining popularity as a viable solution. Across the border in the United States, the industrial real estate market continues to evolve. With challenges such as rising construction costs and limited available land, the conversion of existing properties into industrial condos offers a strategic alternative. This trend highlights the adaptability and resilience of the industrial sector in meeting the changing needs of businesses. Berkadia has brokered the $73 million sale of 2 adjacent apartment buildings in South Baltimore, known as 1901 South Charles. The properties include the Lofts, with 193 units built in 2012, and the Flats, with 152 units completed in 2015. These properties, located across the street from each other, were 95% occupied at the time of sale and are certified LEED Gold. The transaction was managed by Drew White, Brian Crivella, Carter Wood, Bill Gribben, Yalda Gamarian, and Cole Carnes of Berkadia, representing the seller, New York-based Benefit Street Partners. The buyer, FPA Multifamily from San Francisco, assumed an existing HUD loan as part of the transaction. The Lofts and the Flats offer a mix of studio, 1-bedroom, and 2-bedroom units averaging 853 square feet. These units feature fully equipped kitchens with granite countertops, oversized windows, full-size washers and dryers, walk-in closets, 9-foot ceilings, and select units include patios or balconies. The amenities are quite impressive, including a 5,000 square foot residential lounge, a courtyard with grilling stations, a 24-hour fitness center, a rooftop deck with views of the Baltimore skyline, and indoor parking with 534 spaces. This sale is a significant transaction in the multifamily sector, reflecting the ongoing demand for high-quality residential properties in urban areas. It's interesting to see how the market for multifamily properties in Baltimore compares to trends we're observing in places like Kitchener, Waterloo, and Cambridge, Ontario. In these regions, multifamily developments continue to attract interest due to their potential for stable returns and the increasing demand for rental housing. Similarly, in the United States, cities are seeing a rise in demand for multifamily housing as urban living continues to be a preferred choice for many. The sale of 1901 South Charles is a testament to the robust interest in well-located, amenity-rich apartment buildings, and it's a trend that's likely to continue as cities grow and evolve. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.